Great to be here.
Do you
Good morning.
still hold that view? I mean, given what we're seeing in the markets right now, a reassessment of risk, and perhaps this war could be longer than you think.
I think that's the key, right? Duration is the key over here. I think there's enough buffers that the global economy has to get through a week or 2 weeks. If this were to go on for weeks and months, then of course it represents a big macro shock. I think the key constraint in the near term, or the binding constraint, is going to be storage facilities in each of these oil producers, right? It's because once you hit the storage constraint, that production begins to shut down. And then once production shuts down, then you have a longer impact on higher global oil prices. We shouldn't forget that before the conflict started, the crude market was in a structural excess supply. Our estimate was crude would go to $60 or below this year in an environment where growth was quite strong. So we're seeing a large geopolitical risk premium, right? And so if this were to abate in a few weeks even, we expect by the second half of the year, crude goes back, the gravitational force is again back to 60 or 65. So the duration, the key here is how long will this continue in the medium term, and more importantly, in the near term, when the storage become a binding constraint in different countries. For some countries, it's 4 days. For some countries, it's 15 days. This could become non-linear quite quickly.
So you talk about duration, could be weeks, could be months. Trump has already said 4 to 5 weeks. I mean, at what stage, at what duration would you be worried?
I'd worry if we go beyond 2 weeks purely from an oil price market. So this is going to represent a shock to the region for sure, in terms of remittances, in terms of, tourism. The question is, does this proliferate to the broader economy? And the transmission mechanism from the Middle East to the global economy is oil prices. So 15 days from now, if there is no let-up in things and you start getting very sharp increases in production cuts, then the lingering effect on oil prices, even beyond when this conflict ends, will be longer. And I think, therefore, the next 2 or 3 weeks becomes really crucial.
You talk about how it depends on countries and the buffers that they have. What would it take for this to impact the world, for it to be leading to a global inflation issue?
Yeah, I think that will take, a crude going up into triple digits. And it's not just going up on impact, right? It's staying there. I think the key is it's not so much the price, it's the price times how long it stays there. If it stays there for a week, the world can get through this. If it stays there for several months, then there are different impacts. First is you get a purchasing power squeeze on households because inflation will go up. And then central banks will be much less inclined to look through the shock because it won't be a matter of a few days or a few weeks. They'll worry that this will affect inflation expectations. So I think, once you get past a few weeks, if oil remains elevated for several weeks or months, then we get into this having an impact on global growth. The good thing about Asia, Haslinda, where we're sitting, is the starting points are quite favorable on two fronts. Inflation in this region has been very benign, right? Almost too benign in some countries where core inflation is too low, reflecting slack in the region. Part of this is because Chinese disinflationary forces in Asia. Now, that's a good thing because when inflation is much below target, central banks have a little bit of room to work with before crude pushes inflation up, A. B, even current accounts and external imbalances, which is the other area this will impact, right? If you're a current account surplus or current account deficit country, are in much better shape. You look at the North Asian economies, Korea's and Taiwan's, they've had surging tech exports, right? So the current account surplus is very large. If it means higher net crude imports, means higher LNG imports, you've got buffers to work with. India and Indonesia, both current account deficit economies. India's current account deficit is less than 1% of GDP. So is Indonesia. So the starting points, at least for Asia, both from external imbalances and inflation, is quite favorable.
But inflation is benign precisely because oil has been pretty cheap. And you talk about the buffer. How much buffer? If oil remains sustained at $90 a barrel, which is possible.
Of course, that's going to matter. But I think inflation has been benign beyond just oil pricing. There are at least three factors here. One is commodities have been contained. The second is on goods prices, final goods prices, China has imposed a large disinflationary impact on the rest of the region. And the fact is many of these Asian economies have not caught up to their pre-pandemic path, which means there's slack, and that's meant inflation has been low. But you're right, if oil is at 90 for several weeks and months, of course we have a problem. But we've got a long way to go before we get there.
And China, how far can China provide that buffer? We know that China has enough capacity of oil to last, I think, weeks. I'm not sure of the exact number. Could China provide the buffer for Asia? If it's stable in China, it could be relatively stable for the rest of Asia.
There are buffers that different countries in Asia have. There's some thought that Will Asia be more reliant on Russian crude? Will that be a possibility going forward if physical crude can't move from the Strait of Hormuz towards Asia? So there are degrees. I think the question is, for a few weeks, you can juggle around the pieces. If this goes beyond a month, then we're talking about meaningful production cuts and countries getting impacted. So I think the next 3 or 4 weeks becomes really important.
Is India most at risk?
Well, India is a very large oil importer, and so yes, mechanically the impact on the current account deficit is large. But again, starting points matter. India's current account deficit, a sustainable level, is considered about 2.5% of GDP. We're going to end this year at below 1% of GDP, number one. Number two, India's inflation is at 2%, and most of all, there's a huge stockpile of foreign exchange reserves. So I think the broader issue is, after 2013, emerging markets have been working systematically to improve macro frameworks precisely because we're in this shock-prone environment where one shock hasn't abated and another one's upon us.
The shock that could come next is a very strong dollar. We're already seeing some unraveling of the Asian currencies.
Yes.
We've had central banks having to step in, intervene, and prop up their own currencies. Indonesia, case in point.
Yes.
How concerned should we be?
Again, the region has reserves, but the worry, as you said, is if this goes on for longer and you get correlated shocks. So what are the correlations here? Crude goes up. There's uncertainty, risk of inflation. Gold goes up because many countries import gold as well.
And both are up.
Both are up, and both affect the current accounts. If you're a current account deficit economy like India, it affects your current account. And then you're relying on capital flows to finance the current account. But if the dollar is stronger, then those capital flows are also questionable. So this is where buffers matter. And this is where good macro frameworks matter. So I think the first reaction is panic, but then if investors sit back and think and say, well, these countries have got low inflation, large reserves, fiscal frameworks are fine, I think the second order effect is to sift through this across countries.
How is it looking for a country like Japan, which is also an oil importer?
Yes.
And we're waiting for the central bank to raise rates.
Yeah, I think the developed markets is where the risk of a sustained oil shock paradoxically is higher because they're entering this with much more sticky inflation. Japan's one, where there's pressure both on the currency and on bond yields. The US is one. We forget 6 consecutive years that the Fed has missed its 2% inflation target. Now, it's a short-term oil shock.
But it is an oil producer.
It is, but I mean, if there are higher oil prices, so yes, there'll be a distribution in the economy. Producers will benefit, but consumers will see higher prices, and that's what matters for the CPI basket, and that's what the Fed will have to react to. So the question is, if it's a short shock, a few weeks, the Fed will say it's one we have to look through. But once this is long enough to begin to affect inflation expectations, that's when all central banks get worried and begin to preempt. But I would argue again that developed markets are almost in a more tricky situation because coming into the shock, their inflation levels have been higher and more sticky.